So let us now understand some important rules laid by the Companies Act 2013 regarding the securities premium account. Securities premium account is the amount by which a company issued its shares or debentures at a price higher than its face value. The Companies Act 2013 requires that the premium to be credited to the securities premium reserve account, which is a capital receipt. So the company cannot utilize the securities premium collected by it as per their will. There are certain restrictions imposed upon the uses of the securities premium by the Companies Act 2013. First of all, the Companies Act 2013 requires the securities premium to be credited to the securities premium reserve account, that is a separate reserve account, not to the share capital account. Also, the provisions of Section 52 of the Companies Act 2013 impose certain restrictions upon the use of the securities premium account. Now, we are going to discuss that restrictions step by step. So the first step is already discussed. The securities premium account should be transferred. So the first step is already discussed. The amount of money collected by the company through securities premium should be transferred to its securities premium account, which is a reserve account under the liability head of the balance sheet, and it cannot be transferred to the share capital account. And number B, uses of this account. The Companies Act, the Section 52 of the Companies Act 2013 also laid some restriction regarding the use of the securities premium account. Number 1, the company can use the securities premium account only for the following purposes, that is, issue of bonus shares to the existing shareholders, right of preliminary expenses, right of expenses related to the issue of shares or debentures, provide for the premium payable on redemption of debentures or preference shares, and buyback of its own shares. So according to Section 52 of the Companies Act 2013, the amount of money collected by the company through securities premium, that is at a price, at a issue price higher than the face value of the shares, that money can be utilized only for the following purpose, whose money said a company can issue bonus shares to its existing shareholders. So securities premium account से एक company bonus share issue कर सकता है to its existing shareholders, not to the new shareholders. जो कंपनी सेटअप करने के समय जितने प्रिलिमिनरी एक्सपेंसेस हुआ था वो राइट ऑफ कर सकता है, डिबेंचर्स इश्यू करने के समय जितने एक्सपेंसेस हुआ था वो राइट ऑफ कर सकता है, रिडेम्पशन ऑफ डिबेंचर्स और रिडेम्पशन ऑफ प्रेफरेंस शेयर के समय जो प्रीमियम होता है वो प्रीमियम पे कर सकता है, एंड द कंपनी कैन आल्सो यूज टू बाय बैक इट्स ओन शेयर्स. Other uses, if the company uses the account for any other purposes, it will be considered as a deduction of share capital. If the company uses the money of the securities premium account for any other uses as mentioned above, that amount will be considered as a deduction of share capital, and the provisions of capital reduction will then apply. So let us now understand the journal entries of accounting of share capital. First of all, we should go through a very simple journal entry to understand the basic of the journal entries of share capital account. Take this example. ABC Limited issued 10,000 shares at par. Face value of each share is rupees 10. Application money is rupees 5 each. Allotment money is rupees 2 each. And the first call money is rupees 2 each. So pass in necessary journal entries. So what is given in this problem? Let us understand in simple terms. ABC Limited is a company, and this company issued 10,000 shares in the market at par. Here the par value is equal to face value, so the face value is also written as par. The face value of each share is rupees 10 each. Since each application money is rupees 5 each, the face value of each share is rupees 10, and the face value is bifurcated into the following: application money rupees 5 each, allotment money is rupees 3 each, and the first and final call money is rupees 2 each. Here, so it means here the company is collecting the entire call money through only one call, that is the first and final call. So pass the journal entries. Number 1, journal entries in the books of ABC Limited. Number 1. First of all, whenever whenever the subscribers are booking the shares of ABC Limited by paying the application money, then in that case, from the viewpoint of the company, bank account is coming. So the first journal entry will be bank account debit to share application account. Here the company is issuing 10,000 shares and the application money of each share is ₹5 each. So bank account debit will be 10,000 into 5, that is 50,000, to share application account 50,000. And next, the company will transfer all the share application money to its share capital account. So the journal entry will be share application account debit to share capital 50,000, 50,000, the amount will be the same. And in the third case, the company is raising its shared allotment money after a gap of at least 1 month, as discussed earlier. So in this case, share allotment account. Share allotment account is ₹3 per each and ₹3 each share, and the number of shares is 10,000. So the total share amount allotment money is 10,000 into 3. So share allotment account debit 30,000, 10,000 into 3 to share capital account. So the entire amount of share allotment money is transferred to the share capital account. Now the subscribers are paying their share allotment account. So the company is receiving cash or bank. So the entry will be bank account debit the same amount, that is 10,000 into 3, to share allotment account, total 30,000. And secondly, now after a gap of another 1 month or more than 1 month, the company is collecting its first call account. So the first call account should be transferred to the share capital account. That is, the entry will be share first call account debit. The amount will be 10,000 shares at the rate ₹2 each. So the entry will be once again share first call account debit to share capital account. Here, since there is only one call, share first and final call, so I forget to retain share. It will be share first and final call account. Debit to share capital account 10,000 into 2, that is 20,000, 20,000. And next, the subscribers are paying to their share first call account. So the entry will be bank account debit to bank, that is the cash and bank is coming as since the subscriber is paying the amount. So the entry from the company's viewpoint will be bank account debit to share first call account, the same amount 20,000, 20,000. It should be noted here that in this journal entry we are passing all these journal entries from the viewpoint of company, that is the ABC Limited. So whenever the money is coming, it will be the income of the company, and all the amount should be transferred to the share capital of the company.